You got options. Execute your trade. You bet your money just got made. Convex.
Welcome to You Got Options, an exciting series right here on Top Traders Unplugged, hosted by none other than Cem Karsan, one of the sharpest minds when it comes to understanding what's really driving market moves beneath the surface. In this series, Cem brings his deep expertise and unique perspective, honed from years of experience on the trading floor to candid conversations with some of the brightest minds in the industry. Together, they unpack the shifting tides and underlying forces that move markets and the opportunities they create. A quick reminder before we dive in. You Got Options is for informational and educational purposes only. None of the discussions you're about to hear should be considered investment advice. As always, please do your own research and consult with a professional advisor before making any investment decisions. Now, what makes this series truly special is that it's recorded right from the heart of the action on the trading floor of the Cboe. That means you might catch a little background buzz, phones ringing, traders shouting, as Cem and his guests unpack real-world insights in real time. We wouldn't have it any other way, because this is as authentic as it gets. And with that, it's time to hear from those who live and breathe this complex corner of the markets. Here is your host, Cem Karsan.
Welcome back to another episode of You Got Options from the Cboe floor. Today, David Dredge and I finally meet halfway between Singapore and Chicago and Munich, Germany at the Cboe RMC conference. It's the one a lot of you guys have been waiting for. David and I cover a wide-ranging set of different issues, from brakes in an F1 race car and how that's important for going faster, much like in volatility, all the way to FX and interest rate vol and how those can really diversify your portfolio in the coming year. You're going to love this one. Enjoy.
Yo, live it up, don't settle for less. You got options. Put your skills to the test. It's your call, time to strike. Make your move, grab the mic. You got options. Execute your trade. You bet your money just got made. Convex, time to straight the fade. It's the nexus of the game.
A lot of you out there have been asking for David Dredge for a long time. He's finally here. One of my favorites, also a fan favorite. One of my favorites for a reason. We were just talking before off camera that, with all the developments in AI and all the growth, I have a theory that as AI grows, intelligence itself will be somewhat commoditized, but true knowledge, data sets, unique data sets, will be incredibly valuable. And few people that I know have those unique data sets like Mr. Dredge here. You have been everywhere for a long time. I feel fortunate, much like I think our audience does, to get that knowledge from you on a regular basis, or not regular enough, but every once in a while at least. Give us a little background for those that don't know you, kind of where you've been and how you got into the space.
Okay. Great to be here. Thanks for Cem and I have been wanting to do something, but I don't get to Chicago and he doesn't get to Singapore.
Yeah, we're meeting in the middle here in Munich.
Met in Munich, and it's fantastic. So yeah, I got the rare good fortune, having grown up in Utah and went to graduate school in Berkeley and joined Bank of America in San Francisco so I could stay close to home and not go all the way to a place like New York, which was so far away I couldn't fathom it. And after 3 months in San Francisco, Bank of America sent me to Singapore.
Yeah, what year was that?
1987.
1987. Something happened that year. What happened that year?
Yeah, I got there 2 weeks, the first Monday of October 1987, and got to see, a risk event that in Asia was, at least double the scale and more so in most markets to what happened in the U.S. And, a complete evisceration of market positioning, and in a sense, because back then, obviously, risk was just a stop loss.
Yep.
And when the biggest position in the dealing room got stopped, everybody got stopped.
Yep.
And everybody lost money, whether they were long or short, because the market just went like that, as Hang Seng famously was down 50% in a day. So you can imagine what forward 50%. FX curves and interest rate markets were doing. It was quite a thing.
Yeah. We just had Hari Krishnan on for last episode here at RMC, and you've quoted him in not your most recent letter, the letter before, I know. Risk is not about predictability. It's about vulnerability.
Yeah.
And I think that's brilliant. I think that's a great intro to kind of vol's place in a portfolio.
Yeah.
A lot of us have talked about this, but few more eloquently than you about how, how tail risk is really breaks.
Yeah.
Right. Talk to me a little bit about how you think about tail hedging and volatility. Obviously, that's your, where you and I both swim in a lot of ways, convexity. Tell me how you think about it and how it fits in your mind in a portfolio.
Yeah, I use the Formula One race car example all the time. The guy who wins the 40-lap race is the guy with the best brakes. Right. Yet it's very difficult to attribute the contribution of the brakes because the brakes allow everything. Right. The brakes allow you to drive faster. The brakes allow you to test aerodynamics and engines and transmissions, to explore. And so I talk all the time, and particularly with our investors, kind of the whole concept is build this stable foundation of protection so that you can explore, the upside. You can search for that path to overtake the guy, to extend that compounding distance through time. And, as one of my dredgisms that people attribute me to, it's just math, right? It's just simply about the positive effect to the compounding path of positive convexity in your portfolio. Is your car, the risk is the vulnerability of your car. It's not a prediction of future unknown curves. Make the car reactive so that you can explore opportunities and decelerate in risky environments. And that will fundamentally change your compounding path, which really should be the objective of anybody managing wealth, their own or somebody else's.
Absolutely. And you put some numbers to this in your most recent letters. By the way, if anybody gets a chance, do not miss the letters that David puts out on a regular basis. Not only deep, but incredibly eloquent and wide in their reach. But you put some numbers on this, and I'm not do you a disservice. I'll let you speak to them a little bit. But in terms of allocations and percentages and what kind of performance you can get through this type of an allocation, I know, at 80% equity NASDAQ kind of type allocation with a 20% vol type allocation versus what's standard. Talk to me a little bit about some of those numbers and how you see returns and getting these outcomes in a real sense.
Yeah, I wrote a couple months back and in a paper titled Preservation of what is something that I have sort of a fundamental premise that I've proposed around how sovereign wealth funds should treat their investment process. And our local sovereign wealth fund in Singapore has sort of the mantra to preserve and enhance. I said, well, if that's what we were actually trying to do, right, wouldn't you allocate half of your investment portfolio to preservation strategies? So I had proposed 25% in gold and 25% in long vol, explicit long volatility loss mitigation. And then the enhance, wouldn't you invest in exploratory, world-changing, productivity-building...
Convexity on the other side.
Convexity on the other side. Something that's going to make the world a better place, that's going to solve the productivity issues, the demographic issues, the energy issues, whatever it may be.
Right.
And then I just used a proxy of that. And, until you find somebody who can find those things, let's just use NASDAQ as a proxy for growth investment.
Right.
And amazing, that portfolio that's 50%, you would say, well, that's 50%, David.
Seems unfathomable to most people.
It's too conservative.
Yeah.
Well, that portfolio outperformed their benchmark by 6x in 20 years.
Crazy.
Right?
6x.
Yeah.
Wow. That is a crazy stat. And what was their benchmark? Do you know approximately?
65-35.
65-35 stocks, bonds.
Yeah,
basically.
65-35.
Yeah.
Which, again, I think I said it in that piece. I can't fathom why a sovereign wealth fund owns bonds.
Yeah.
Now, in the case of Singapore, and I suspect many sovereign wealth funds, but in Singapore, the FX reserve manager, the monetary authority, owns enough bonds for the whole country and more. So why does the sovereign wealth fund additionally own government bonds? To me, it doesn't make any sense. What is the point of that? What's the innovation, the growth opportunity of that?
Yeah.
It's just driving slowly is all it is.
Yeah, honestly, I know this is, you're not a big believer in Sharpe ratios, and I agree. Sortino's maybe better, but still not perfect. But a stat that most people don't know is even just the U.S. markets, like 60-40 here for 125 years in nominal terms is at 0.35 sharp. Similar, actually slightly worse Sortino, as you might imagine in the market. And actually more importantly than that is that, sorry, that's the equity. I apologize. That's the equity outcome. 60-40 is exactly the same Sharpe ratio, similar Sortino. No diversification benefit. You are just deleveraging, as you mentioned, kind of your long exposure, but without breaks. You're essentially playing with a slower gas. And again, the reason that people use it so much is because the last 40 years, it has helped a bit, but I think we all know that is a function of a very secular outcome in bond markets.
I say all the time, when I'm speaking to people whose job it should be to grow wealth for the people they're a fiduciary for, the biggest destroyer of compounding paths, the two reasons people haven't compounded. One, poor risk mitigation. And two, bearishness. And the reason they're so susceptible to number two is because of number one.
100%.
And they're driving slowly, Sharpe ratio, which says that risk management is to drive slowly, to explicitly forego upside, to probabilistically reduce downside, and thus the creation of negatively skewed returns, and all the things that everyone's doing to say I've reduced risk by capping the upside. Well, that's not the right way to grow wealth. The right way to grow wealth is to explicitly risk mitigate and pursue upside and turn negative return skew into positive return skew. So I say all the time, you want to own thin-tailed opportunities where you're realizing upside volatility to compensate for the risk of downside volatility. And you want to hedge with left-tailed, fat-tailed risks where there is no upside and you're capturing high fat tail to the downside because the industry has used volatility as risk and said that levering suppressed volatility is an increasing risk, which is what creates the fat left tail.
Completely agreed. You don't talk about this as much, but I also think that, if you can achieve true diversification, true is the key there. You can also preserve capital. I mean, it doesn't get you the tail that way, but the problem tends to be that that word is so rare. It is more possible now than ever. I mean, there are strategies out there that are truly non-correlated, not convex to the other side per se, right? And that breaks role is critical regardless, because there is so little scalability to a lot of these true diversifiers. But that is the other tool, and I think you touch on that a little bit with the gold allocation there that you're talking about. A stat that I put out there, which I think is really, really critical, really important, is we're now, in a world where there's $500 trillion of correlated assets. The majority of assets and investment is correlated. What are those? Just to put names on them: equities, bonds, private equity, private credit, which are just the same thing with leverage, right? Real estate, which you could argue is also incredibly correlated to those same inputs. So this is 500 trillion. On the other hand, up from just 3 years ago, about 5 trillion of non-correlated, about 15 trillion. All of these have tripled, essentially. And I don't think people connect that all these things are related. The reason they're tripling is because, quite precisely, people are waking up to this idea that you have that's so important, that you have no non-correlation, you have no true diversification, and you have no tail in any way. You have no breaks. Everybody's driving without breaks, and nobody really cares about that if they're on the racetrack and if the racetrack hasn't been wet for a while, or like it's very predictable. There's not a lot of, well, guess what? 22 showed that there's a little bit of water on the tracks, and we're going to take this metaphor all kinds of places.
I say all the time, one of another Dredgeism, history alone is a very poor measure of risk.
Absolutely.
Because it only tells you what did happen, not what could have happened. So the simple analogy I use all the time: two guys climbing up a cliff face. One has a rope, one doesn't. Well, financial market backtesting would say if they climbed at the same pace, they had the same risk.
Right.
Well, obviously one has a lot less risk if it's raining the next time they climb. And logically, the one with the rope could climb faster.
Right.
And that's the whole point. Again, get the protection and then take advantage of it and go out and find that convexity to the upside. Go out and pursue cut off the unrecoverable to pursue the unimaginable.
Well, and not just that. I mean, I think we both know, actually a big, I think, core thesis of how you trade is often the least, what seems historically the least likely is reflexively often the most likely. People are rarely fighting. Everybody's fighting the last war.
Yeah.
Right. And it's generally not hedged for the war that hasn't happened.
Well, the reason things are correlated in the downturn is because of leverage, because the financial system allows leverage to accumulate based upon assumptions of low volatility as low risk.
Right.
And so when, super senior tranches of subprime CDOs are the biggest risk to the financial system is when they're priced as though they're the least risky.
Right.
And it's that application of leverage, regardless of the strategy, which is why, like you said, homes are positively correlated. Well, it's because they're levered. And, private credit's positively correlated because it's levered. And so when that leverage or deleveraging happens, stuff that looked like low correlation all of a sudden isn't low correlation.
Right.
And what you find in most of the, traditional, what I call sharp world strategies, optimizing to a Sharpe ratio, you have low correlating faux diversifiers that are only low correlation in good markets,
right.
which is destroying your compounding path. And they turn out to be higher correlation in bad markets. I mean, one of the worst measures I see, and I see this far too often, people talk about averages. Average is meaningless. The average means nothing. The average expected return is meaningless.
Right.
The average correlation is meaningless. And
Absolutely.
When we talk about convexity or concavity in an investment structure, really we're talking about correlation.
Right.
So if you're convex, you have increasing correlation in good markets and decreasing correlation in bad markets. But most investment portfolios that are structured to a Sharpe ratio optimization have declining correlation in good markets and increasing correlation in bad markets. They're concave.
Right.
And that creates what in our world people would call volatility drag, which is a destroyer of compounding paths. And that's really it's just math, right? It's just as simple as that.
Yeah, you actually make a point. We're here at the Cboe's RMC conference, but that the Cboe's put cover strategy, talk to me a little bit versus their short vol strategies has dramatically outperformed.
I don't
people don't refer to that, right?
I don't want to upset anybody.
I think it's fair.
But, we go through, presentation after presentation, not just here, but everywhere we go, of the benefits of vol selling or covered calls or vol premia harvesting, et cetera. And I always like to show, and I'll show at the conference here, the Cboe's vol indices that show the buy right covered call index performs here, and the put right index performs here, and the buffer index perform here. And the put protect index, which buys the puts and owns the underlying risk, is here.
Right.
And my good friend, who I'll be on the panel with tomorrow, Jerry Hallworth, always makes it so clear those options are non-recourse leverage. And so you can underwrite the risk selling the option, or you can take on the non-recourse leverage and own the risk.
Right.
Well, obviously, if the compounding path is most significantly determined by the biggest ups and biggest downs, that put protect always has more potential upside and less potential downside than the other strategies. So through time, not only does it perform better, but always had the chance to perform even better.
Yep.
Which we don't generally recognize when we measure historical performance.
Tough question. How do you offset an issue like 22, right? And what happens when you have, let's just imagine a scenario, right, where we just have, stair steps down for a year or two or three or four, right? And we lose 80% that way. So maybe a convex kind of instrument doesn't really pay the way as a function of time. I mean, how do you think about those diversification there and offsetting the risk?
We're hedging in what we do for people. We're hedging correlation risk, and everybody's portfolio is exposed to correlation. And most people that we talk to, pension funds, sovereign wealth funds, are very good at managing the risk that they're measuring. Mm-hmm. And they measure risk as equity, FX, interest rate, credit, and commodity inflation.
Right.
But what they're missing is the risk in between, which is the correlation.
Right.
And so, we hear all the time that S&P hedges didn't work in 2022 when the market went down. But the risk in 2022 was correlation.
Right.
And interest rate hedges worked really, really good.
Right.
And of course, in 2021 and 2020, by far the cheapest convexity in the world, because that's where all the supply was in interest rates.
Absolutely.
So you simply need to have the discipline and the sort of agnostic nature to own the convexity, where it's expressing the lack of capital protecting the implied leverage in that risk.
Right.
And so you just need to follow the opportunity of where cost efficiency exists and stop thinking that you can guess what the risk is going to be and go and hedge that.
Absolutely. I think it's so well put.
Yeah.
That's a hard question, by the way.
Yeah.
And I hope everybody out there understood that. I mean, the reality is it's in true convexity, speed of move and liquidity crises, that true tail is the only thing to buy.
Yeah.
Right. And you have to have that in your portfolio if you want to cover vulnerability, as we said. That said, there are other risks in a scenario that aren't tail. And those need to be, well, they're different kinds of tails, right? They are, to your point, a non-correlated outcome. You can actually cover through diversification and tail through that non-correlation aspect. And I think that's so important.
And of course, everybody should be managing the risk they're managing, right? So, people should be good at constructing the risk they want to take in their equity sleeve or in their emerging market sleeve or whatever that is. But in between those sleeves, the residual risk is correlation.
Right.
The assumptions people make around diversification is always what lets them down.
Right.
And I hear, day after day about, some pension managers' expertise in how they construct and manage their risk.
Right.
And without fail, the thing they're not measuring or managing is correlation.
Yeah.
And the thing that always explains their relative performance to a hoped for compounding path is going to be the concavity of their correlation relationship to their target.
Amen.
And so they're not getting the best years, and their correlation is letting them down in the worst years. And so it's how you deal with that, and dealing with that means going out and finding, I use the forest fire analogy.
Yep.
It's not your diversification solves the problem that lightning striking a tree doesn't blow up your portfolio.
Right.
It's if that fire spreads through the interconnection of leverage in the system, dry brush between trees, that's the problem.
Absolutely.
And that's what hopefully guys like us, guys like you, are there to help with by saying, well, we've got some idea where the endogenous risk is because we're on the other side of the leverage buildup of volatility selling.
Absolutely. And I think to you and I, diversification is table stakes. And that's why we end up talking so much about kind of vol and it. But I do think, most people today, even at least on a non-institutional level, are not even getting the diversification part.
Yeah.
You need to do both, right? You need true diversification. You need all the 10% returning strategies that are all non-correlated with each other, that are one sharp, that together are two sharp, right? To get, or let's say Sortino, to kind of better clarify. But even so, you have to somewhere along the way have that when the correlation eventually does go to one.
Yeah.
When the bigger fire blows through things, that you are protected as well. And I think it's the pair that is so powerful, right?
Yeah. I mean, everybody needs to be conscious of where they're exposed to implicit or explicit leverage.
Right.
And the left-tailed nature of that again, so destructive to the compounding path. And nothing drives me crazier than people constantly foregoing the upside while maintaining downside exposure because they probabilistically it won't happen.
Right.
And that's just a destructive path through time. And I wish fiduciaries weren't allowed to do it with other people's money and somehow reward themselves with compensation, but it is almost generically how the fiduciary industry works. I mean, banks are obviously notoriously short tails with bounded upside, collecting compensation for themselves and socializing losses when things go wrong. And it's
structural. I mean, not to get in any way political or anything, but like the reality is that short-termism is one of the biggest drivers of convexity. If we are always going to do what's good today, tomorrow, it creates momentum to recent outcomes and eventually undoes itself. So,
back to the race car analogy.
Yeah.
If as is generally the case in the fiduciary industry, if you're optimizing one lap at a time in a 40 lap race, you're going to target the average lap speed and sell the straddle.
Yep.
But if you optimize back from the terminal 40 laps, you will see that the difference in the compounding path is the fastest and slowest parts of the track. And it's going to say, buy the straddle.
Right.
And buying
or
the
when the
straddles,
person slides off the track or, has to change 2 tires because,
And so it's, again, and I wrote about it a little bit this month, quoting a lady, Judith Rodin, who wrote a fantastic book called The Resiliency Dividend, that resiliency has a lot more benefit, and she's talking about city planning, right, than just saving you from the flood, because it allows you to grow and develop and innovate. Well, the same with an investment portfolio. That resiliency allows you to explore the unbounded upside potential of the investment universe, which is where growth truly, truly comes from.
Yeah.
And so put really good brakes on your car and go learn how to drive. Go learn that you can do a lot more than you're doing trying to anticipate what the future curve is and taking your foot off the gas all the time, right?
That idea is so powerful. I think some people, but everybody, I think once they hear it, it's like, oh, I get it. That's so important. But how do you deploy it other than just buying puts on the S&P or whatever, right? That's a bit of the trick, right? Because it's not always and often it's not the equity index, right, that you want to own. I know you in particular play across the board. And part of why I love our discussions so much whenever we get to have them is you being in Asia, particularly getting to play for a long time now, FX and interest rate vol, commodity, whatever comes your way. I think you're telling me you had a big trade in, the Filipino, currency not too long ago. But the point is, give me a little bit of perspective on some of the areas you have found fruitful, how you think about going forward, how you could get convexity outside of just equity tail. And I'd love to dive into kind of some of the more practical parts of.
We call ourselves value investors in convexity. Value in volatility markets is the same as value in any markets, supply and demand. And it's all about price. Everything you hear me talk all the time, everything's price. The only signal we care about is price. And what drives that price is the supply of volatility through what's commonly known the structured product world, which is getting ever bigger in the US and Europe, but has been very big in Asia for a long time, not least of which innovated by my old Baker's Trust business back in the very, very early 90s. And what drives that supply buildup, again, is the flawed risk and accounting methodologies in the sort of food chain of market participants. And so the buyers of the structured product, they're getting the enhanced yield in some form through embedded short volatility, with a credit intermediary bank that's measuring the risk of that embedded derivative using a value at risk methodology, potential credit exposure, and then passing that derivative on to a sophisticated global derivative bank who's using some sort of option pricing model that's measuring value at risk and 2 standard deviations and stuff. So you've got this entire food chain of guys who are accounting for the enhanced yield of the repackaged option premium as calendar year accounting revenue, bonusable, and not accounting for the tail risk of the embedded derivatives in this food chain of how they've been constructed. And so quite naturally, the supply will very quickly overwhelm the demand of the people who are buying the options that are recycled into the market, who have to account for the cost of those options, but don't get generally the look through to the risk benefit of owning that tail that the other guy is not recognizing.
Right.
And so you get massive supply and demand imbalances on occasion, more often than people would imagine, in places where, if the entire pension system, obviously famously right now, if the Taiwanese insurance companies aren't accounting for the residual tail of the embedded Bermudan swaptions in their massive portfolios of 50-year, 5-year callable note structures, and they're calling all the enhanced yield annually accrued on what they've booked as a 5-year duration to the call date as bonusable profit, well, that's going to crush the demand for volatility on the other side.
Right.
And then inevitably, something comes along, in this case, interest rates go up.
Right.
And all of a sudden, the stuff that they've been allowed to value by local regulation as a 5-year duration bond is a 50-year duration bond. Because it's not going to get called like it did every other year up to that point. And now you got a problem. So you have massive, just like you have famously in the hold to maturity books of U.S. banks, massive unrealized losses on these things that have never been correctly accounted for and are not capitalized.
Right.
And so you've got this long workout thing, and you and I have talked about it for years. Who's going to buy the bonds? Because the guys who bought them, what I call rational accounting man, as opposed to, they're not making an economic decision about the 30-year investment value of long duration bonds. They're following accounting rules of their bank and annual bonus cycles.
Right.
And they filled up on these things at really, really bad prices that no rational person managing their own retirement saving, no rational person in the UK is going to 5-time lever gilts with their own money at a 0 yield.
Nah.
But pension funds regulated to do so happily do so and then have to get bailed out. And so that creates this, massive fat left tail in these structures of things that end up attracting leverage that literally have no uptail, right? Only have a downtail and massive leverage. And that is where opportunities flow, hopefully, into our world, whether that's in FX or credit or commodities or equities and indices, single name products, whatever it may be, that vol supply. So we've had a great week here talking about and hearing about, the proliferation of vol selling strategies and ETFs and what's happening around the world, which is just, I wish I brought a bigger bucket to fill up as we were here.
Yeah. I always find it amazing that, I remember the first time I think we talked, I remember asking you about your signal. I'm like, what's your signal? How do you decide where? And, the answer is price. When people sell it to me at what seems like an irrationally low price, inevitably you're getting close to kind of the bottom, right? And before too long, a lot of situations that turns in is the best thing to buy, not just because it's cheap, because reflexively it actually undoes itself.
Yeah, and so remember, for us, we're always working for the benefit of our investors. So our investors have freed up capital from ineffective diversifying strategies to get something that's very explicitly diversifying, convex negative correlation, so they can go and take more participating risk. And so as that's getting cheaper and coming and we're becoming more effective, more asymmetric in our potential protection, they're benefiting in that rising market. And then, of course, our challenge becomes to grow and maintain that sensitivity. You think about, strike sensitivity as the market if I buy a bunch of 30% out of the money options, long-dated options, the market goes up 30%, there's not much sensitivity. So how are we maintaining sensitivity? How are we maintaining duration and expanding the potential convexity through time as they're benefiting from the superior compounding path of carrying more participating risk, more upside convexity?
How do you think about, one of the challenges of that is, a scenario like Korea, right, where we saw dramatic vol compression for honestly decades, forever. It was by far the cheapest vol available for a long time. The problem was, you could hold that against a long book and the long book would make money, but then into a decline, often it wouldn't perform.
Yeah.
How do you deal with those situations given sometimes just dramatic supply demand imbalances from a structured product perspective? Because yes, to your point, when things get cheap, often, not always, right? There's no complete cheat code there. But often you get that quicker than you think renormalization and value from it. But there are times where you can sit on something that's cheap just because of the supply demand imbalance for forever and not really get the convexity you need.
Yeah.
How do you think about that? It's something that we all, nothing's perfect.
This is the challenge for us. And like I said, we very much consider ourselves bottom-up value investors in convexity, which sounds weird. So we're tracking that supply.
Yeah.
So if something's percolated up that's created a Vega supply that's coming to us, we're trying to understand what's generating it, how much is it getting done, who's doing it, how are the banks managing it, how are they hedging it, and low doesn't mean cheap, right?
And I think that's critical. I just want to make that distinct.
So how we build layers of convexity in our portfolio is really based upon how effectively we understand the supply and demand dynamic.
Yeah, it's critical. I just want to touch on that. That's a bit of my world, as you know. Like cheap is important, and I agree with you often, at least in a relatively normal functioning set of markets, that can ultimately undo itself. But there are situations, particularly with structured products, that are not levered, that are not as concentrated in the sense that they are distributed over large sums of people, that are hard to force a buy effect or a release of that vol. And we're starting to see that here in the U.S. Well, I say here, not Munich, but
I think we talked about some stuff that we've been working on lately. Well, we started aggressively, actively working on this 22 months ago and printed our first trade last month. So it took that long for the accumulation of structured product activity and hedging activity and spreading of that risk across other market participants that were willing to take it on in different forms that maybe we wouldn't be willing to take it on, until it finally gets to us in the form that suits our book and how we want to diversify our book and how we want layers of convexity and how we want, potential highly asymmetric risks. And we'll pass on things for a really, really long time because it's not yet what we would consider good value. And that's the job, in a sense. That's the active management part.
Yeah, I love your ability to be patient, right? And I think it's so important to let it come to you, and only that combined, I think, with you're fortunate enough to get to see all the things, right? And at the right moments. I think that's really paid dividends for you guys.
Yeah, the decades of being in that food chain and knowing the participants and working closely. We have really unbelievably tight relationships with our derivative counterparty banks, and we're working with them day in and day out across global derivative markets. And they know if they've got vol to sell, we're happy to talk about it and try to figure out how to do it. Likewise, they know if they need to buy it back, we're probably a good place to go because we own it.
Yep.
And in those difficult times, when times are difficult, finding a seller can be tricky. That's the point. So it's good to know who owns it if you need it.
Right. You get the liquidity too when you need to get out, which is key. Yeah. Talk to me a little bit about, I kind of know this from our conversations over the last couple of years, on and offline, but talk to me a little bit about where you found convexity the last couple of years. Walk me through maybe some of the stories and things that have come across your desk and the opportunities, to the extent you're willing to share.
Yeah.
And let's then talk about what you're seeing now and what you see going forward.
So I know when we talked at the beginning of the year, and I'd written my note titled Deja Vu, and we were comparing sort of similarities between that 1995 through 1999 window of U.S. equity markets, just up 5 years in a row, 28%, I think, annualized, as volatility is breaking off all over the place, all over the world, and how similar I felt about what's been going on, 23, 24, 25, where you're getting this, constant rise of equity markets, but vol events all over the world. And yet the vol supply keeps coming and jumping around. So, last year, and we talked about it on the call, last year very much, the vol supply that came that we found most interesting, convexity, was in FX space. And it was, a prolific around the world, but most specifically euro and euro-related, euro sterling, euro Swiss, euro-related pairs, just massive amount of vol supply. Now, turns out that was a pretty good thing to own in the early part of this year. And then I thought it would, it was gone. But then by middle of summer, it was back again.
Right.
And it's back again at, the same prices that we were getting at the sort of historical lows of convexity in March of 2024. It was back in July of this year. And so I always say it's, just turns out as a general rule, whatever's the cheapest thing turns out to be the thing that's the biggest risk.
Yeah.
And, if you read what my good friend Russell Napier or various people are writing about France, you could get an impression that Europe's pretty risky. And yet one of the cheapest convexities in the whole world 2 months ago was euro.
Yeah. I love FX too, because it doesn't have as much of this structured product, structured compression as much. There are other things driving that make things go too far, but I generally...
Well, it is very massively driven by structured product, but that's driven by corporate treasury businesses.
Correct.
So it's importers, exporters monetizing through option selling the
not as
benefit
distributed, right?
they have of either higher or lower currency. And so it's very concentrated. And it's quite smart in a sense. It's not a bunch of retail guys.
That's exactly right.
It's professional treasury books, big treasury books. Obviously, the scale of this stuff it dwarfs many other vol markets, and so that creates opportunities. And as always, like everything, as the vol gets compressed, the leverage inherent in these strategies goes up.
Yep.
And so because lower volatility is less risk, to add more leverage, and because the vol gets compressed, the returns on them gets lower. So to meet return hurdles, turns of leverage and duration extensions get built into it, which then eventually helps it find its way to us. But increasingly, and what's been talked about a lot here, we've become increasingly interested in a lot of the structured product flow, which has been very, very heavy in Asia, and increasingly I'm learning more and more heavy in the US, is on, there's been a big shift away from index sort of auto-callable worst of products into single name worst of auto-callable products. And obviously now we're getting ETFs on auto-callables and all of, the explosion of call selling ETFs and bust for ETFs and all this stuff is providing convexity into the system, which eventually gets recycled. And then hopefully over time, some of it will find its way to the little old me in Singapore.
Yeah. Yeah. It sounds like you're increasingly interested, slowly building, part of your book here in the U.S. too, which is interesting. Obviously,
we'll go where the supply is.
Yeah,
and if the behemoth that is the Asian wealth management, private banking, retail client machinery that has more lifetime experience in auto callables than any other market in the world decides they want to do Mag 7 auto callable structures, well then, and then that triggers the next guy and the next guy. Well, eventually that's going to be where vol gets compressed and where leverage builds and where correlation risk builds. And that's exactly the kind of stuff we're interested in.
Yeah. But similar to what you said before, I mean, you have to be careful to not get stuck.
No.
Just S&P or something where it could just remain somewhat compressed due to a massive set of supply. You kind of have to find that spot where you can get convexity and leverage where it could turn dramatically. Your point about FX, which you mentioned again about almost a year ago now, which very much kind of played out, was tied to this view that it reminded you, if I, correct me if I'm wrong, of 97, right? And like Asian flu and Russian ruble crisis and all the things that drove that period. I agree in terms of kind of liquidity being pushed into the system, right? That was right after Greenspan lowered the natural state of unemployment and drove what essentially was a bubble, right? That went to 2000. And again, definitely can't help but see the similarities there. But I also think it's different, right? Back then we were in a, from a macro perspective in a budget surplus.
Yeah.
Russia had just collapsed, and we were, the U.S. was a global hegemon. Interest rates are heading down, secularly more, right, than just cyclically. You see a lot of the opposites now, and a lot of those things for me, and for me, talk about this remind me of, not to mention the political side of things, remind me much more of a 60s and 70s. We're kind of getting a confluence of like this more structural bubble that's driven by all the liquidity and everything we've talked about, but paired with a structural, I don't want to say fourth turning, but right, like there are these elements that are driving this confluence of both this big kind of 60s, 70s structural populist rebalancing, deglobalization, global conflict, all the things simultaneously to all those flows kind of hitting their what feels like a coming terminus at some point.
It is a unique environment, and everybody says that, but again, my sort of number one obsession is demographics.
Yeah,
and I always say you can't talk about anything, any country, any economic scenario without talking about where that bulk population cohort is. And I wrote in my note a couple months ago, that you should end every economic related conversation with this addendum add-on. And for every year going forward, there will be fewer taxpayers. And you really start to understand the challenges around and the uniqueness around when we say, well, this is like, deja vu for 95 to 99 or like the 67. But you say, wait a minute, where was that bulk population cohort? And so I have this conversation all the time. I was one of the early guys talking about fiscal dominance and financial repression. That financial repression isn't the solution to our current problem. Financial repression is how we got here. We've been doing financial repression basically since 2000. We've been keeping interest rates below, basically since inflation targeting.
Right.
And we've been, dealing with the population demographic issue to a great effect by using the wealth effect as the driver of growth, as the driver of consumption.
Right.
And sort of, I would argue the Greenspan put inflation targeting was very much, let's break the trade-off between employment and price stability by claiming that asset inflation isn't inflation and driving growth and the population drag on growth through wealth effect.
Yep.
And so I really think that that's driving a lot of this wealth segregation issue. And because we've financially repressed, we've pushed so much wealth into that cohort that's now moving into retirement, just as we have fewer taxpayers coming up behind them.
It's just more leverage to the long, right?
It's just,
if you think about it, it's one thing to say, okay, everybody's longer, has greater, average retail exposure to equities is at all-time highs. But what people don't also realize is how leveraged everybody is structurally just by the number of people who are driving demand. I think the stat is that the top 10% of the U.S. drives more than 50% of all consumption in the U.S. now. That is a record, up from 34% just 15 years ago. That's a wild stat that we've been, that distributionally that's happened. And we haven't even talked about the political effects, right? How I talk about the populism, right? And how much that's driving the fiscal dominance. But this administration now is actually, despite publicly kind of talking about going that route, they're actually zigging away from it, partially because I think Bessent et al. Are fully aware that there's no way out. There is no way out. You cannot rebalance inequality and not pay the piper. They borrowed from the future. Now I say it's not this administration. It's many administrations. It's going back forever.
This is a sandpile that's been building for a long time.
They're in an impossible situation. And if you really want to give the political, the populace what they want, and particularly the younger generation who's seen the greatest effects of this, who are at 40% of the wealth creation, household formation, right, of baby boomers, all the stuff we've talked about, you can't do it without hurting markets and bonds. And so no better time for convexity. No better time for diversification.
Obviously I get to speak to pension funds all over the world. And so people will ask me, back to where you started, risk is about vulnerability. Right. What are people exposed to? Well, certainly if you speak to pension funds in this part of the world, they're exposed to inflation, right? These guys are still way bond heavy. They've been debasing the savings of their population as that population's moving into retirement with higher cost of living because of the surge of inflation that this has created, with a smaller tax base, who's going to have less savings because they have to pay more tax and a higher cost of living. It's a negative feedback loop which is literally what we talked about in January.
Right.
Can, Scott Bessent with his 333, can they reverse that feedback loop? Well, they looked like they were going to try and then said, no, too hard.
Yeah.
And now you're back into this negative feedback loop. And so my Hunger Games analogy, where there's this ever-growing competition for every scarcer supply of savings to fund people's debt.
Yep.
And now, Germany, where we're sitting, has removed their own debt cap and is going to increase their issuance. And France is, doesn't have a sustainable path that anybody can describe anywhere. And how France is going to avoid the necessity of capital controls, I can't see.
Yeah. How
they can't trap savings and hold it in France is very hard to fathom. So this problem is, obviously, famously, China is going to lose 600 million working age population this century. Well, find me a historical precedence to explain how that works.
Yeah.
I don't know one.
No, I think you can't think about this without really saying it's turning into economic warfare, because you said Hunger Games, right? That's essentially the same thing. There has to be, if there's no way out, right? Well,
Yeah.
So somebody's going to die on the way out the door.
Who's going to be the last guy issuing bonds to the last guy with savings?
Right. And I think you really have to think about that at this stage in the game, because if you don't think the Fed is going to go do, Project Twist, I mean, they've already announced it ultimately, like they really have almost gotten to that point. Next, you're kidding yourself. They are going to try and keep the long end of the curve higher. They've actually added, as there was a couple people on the Fed now talking about it as the potential third mandate.
Yeah.
I mean, that's crazy.
Yeah.
But the reality is most people think, oh, well, they're big enough. They can do it. So why would you, don't fight the Fed. Why wouldn't you, true. Except in this situation, we're talking about long duration. And when you start talking about 10 or even 30 years, you can try the Fed. This is one place where the Fed might be outmatched, which is ultimately, at least in the long run, you can't keep real rates negative to the extent that will eventually be necessary. If you do, it well documented will drive a structural inflationary loop. I mean, if I can buy something, I borrow money at 3%, and inflation's 5% a year, guess what? I'm going to go borrow a lot of money at 3% to buy more of that stuff. And guess what? Then it no longer goes 5%. Then it's 7%. And then it's 9%. And then it's,
ever since they innovated QE, the biggest opportunity cost in an investment portfolio has been owning bonds.
100%.
You should own everything else, obviously. And it strikes me they have very little choice but continuing that, in which case owning bonds isn't going to grow wealth. The guy selling the bonds explicitly telling you he's trying to debase them.
Right.
And so again, they're playing this forever game of trying to bring demand from the future to today, knowing that there's going to be fewer taxpayers in the future.
Yep.
And that is inevitably flawed and must be a bad solution, but nobody thinks to the second order effects of these things. And so it seems to be this thing could keep going. So back to what you said, be convex. Own stuff that benefits from the asset inflation that they so desire, and own stuff that protects you if it goes wrong.
Right. It probably, just to prognosticate a little bit, I mean, it probably, to your point, in a Hunger Games scenario, first hits overseas, right? Who, maybe it's France, maybe it's, but the point is those things are, I think starting in the U.S. is unlikely, right? They're gonna crowd out as much as they can. They're gonna try and push, as the bully in the room, the risk overseas. Eventually, they're gonna get dragged out to sea as well. The question is timeline. How does that work? But I've talked about this before. You mentioned 97. That 68-82 scenario, it wasn't equity vol that actually paid off long term. You had some short term opportunities right throughout that period, but what really, really paid off is FX vol, obviously interest rate vol as well, precious metal vol. I mean, the most convex instrument, both in terms of performance and in terms of total volatility, was actually gold.
Yeah.
And
it's behaving a lot like that.
Yeah, 100%. We talked about that years ago, by the way. You and I did.
A lot like that now.
Yeah. And I think it's fair to say that that's probably not over, given the risks out there.
Again, in the part of the world I sit, reserve managers have been building reserves, which, if you think about what that actually is, it's just QE.
Yeah.
They're just printing money and buying somebody else's bonds.
Yep.
They own enough bonds, and they know that they're getting debased in this bond ownership. So they quite logically have been, I assume, of course, obviously you can see the numbers, shifting at least some of their ownership. Now, particularly as we've had a very weak dollar, that results in more intervention accumulating reserves, which results in more diversification into something other than the bonds that they already own way too much of, a la gold. And you've seen what's been the result of that.
Yep. There's about 25 to 28 trillion dollars of gold reserves. About 22 of that is in vaults, untouched, will likely never be touched.
Yeah.
Right. And what's interesting is that total value, which is now, let's say 27, was 9 just 3 years ago. But importantly, much like a venture capital, offering it, like, there's a little bit of float. There's not a lot of float, right? I mean, there was maybe 1 or 2 trillion, which is now probably 5 or 6 trillion, right? As a diversifier to the 500 trillion sitting on the other side. I mean, talk about a supply and demand imbalance. I mean, you could go look at crypto, and that's why crypto's also tripling. It's now kind of come along for that ride.
I talk about a thin-tailed instrument, something where, it has downside moves, but you get rewarded with a massive upside tail as well, right? You're not cutting that off at all. So, whether it logically makes sense or not, it's been a great reward for people willing to participate in upside tails.
Yeah, I think the flexibility and portability of it, obviously paired with its association to the entities that are getting the most, we have $125 trillion wealth transfer that's happening in the next 20 years. And the people that are getting that money believe, and that's all that matters, right? That it is a store of wealth. And importantly, it is portable as well. So both of those, I think, have, it's crazy to say after, not just a triple in 3 years for both.
Well, and they both have exactly what you were saying, and something that our mutual friend Mike Green often talks about a lot in the world of passive. The marginal dollar in that, because so much of that is locked up and not tradable. So the marginal dollar keeps driving this sort of
supply and demand
skewed uptail, and keeps going. And
which is the same thing that happens, by the way, in the Mag 7 and venture,
this is Mike's point about passive.
It's literally the same exact thing, but now you're actually talking about diversification as well.
Yeah.
So I think it's incredibly compelling to be able to get some diversification and get that convexity in those products.
We one of the sample portfolios that sometimes we show, we call the anti-fiat portfolio.
Yeah.
Which is Bitcoin, gold, and long vol. Yeah. And that's outperformed, less risk, more return than, any traditional portfolio for the last 6 years.
Yeah. And incentive wise as well. I mean, if you just think about those that are pulling the reins, right? And this is not a new story, but, kings have been shaving coins since time incarnate. Why? Because it's easier than taxing people, and you do it slowly and incrementally and nobody sees it. That's what happened 1968 to 82. People don't realize the equity market went nowhere. So people felt less pain. It was less volatile because it was a world of nominal illusion.
Right? I'll come back to my previous point about the demographics.
Yeah.
So in a sense, you got away with that and came out the other side because that population bulk, the pig and the python, was just going into their peak earnings, peak tax paying, peak saving, peak investing period. Now they're stepping out of earnings, savings, investing period. And so now shaving the coins, intentionally creating nominal growth through inflation to offset growth drag through population decline is probably a really, really bad idea, is an increasingly bad idea as the pig moves through the python, right?
Yeah.
And so I have this conversation with some good friends, who will point out how well financial repression worked in the post-World War II era, the yield curve control of the 50s. And I said, but where was the pig and the python?
Right.
Very different to today. And the financial repression today, then when you financially repressed and the high government debt that was driven up during the war to fund the war, contrary to the austerity through the depression and the war of the private sector, allowed a crowding in of private sector borrowing as the government shrank and debt to GDP declined to the financial repression. But we've been financial repressing for 25 years and debt to GDPs are higher than they've ever been and growing. So in a sense, it's not working and doesn't strike me that it will work when every year going forward, there's fewer taxpayers.
Right.
So it's a real problem. It's a real interesting dilemma, and particularly in Asia where I am, where, Japan's working age population peaked in 1995. So they're, way, way, way ahead of everyone else. And of course, China with the one-child policy, probably the biggest central planning mistake in history, maybe, has locked in a reversal of the dependency ratio of unprecedented scale that, reverses the cost benefit of onlining global labor that led to a lot of the disinflation of the 90s and early 2000s. Now you're going the other way and you're having this massive disappearance of working age population around, Japan, Korea, China, where I spend most of my time. And it's an interesting dilemma.
It is. And I think if you really step back enough, right, you just really take a look at the big picture. I mean, 1929 to 1949, right? People think of that as the Great Depression and the amount of losses that we saw, from a nominal perspective, obviously are massive and some of the biggest, probably the biggest in history in at least the US. But what most people don't realize is that decline in real terms, that period is almost identical in real terms to what we saw from 65 to 83.
Yeah.
That really, one's a deflationary environment.
Yeah.
One's an inflationary environment, right? And I think, a lot of that is a function of a much stronger fiat now, Federal Reserve, who's able to shave those coins and manipulate the situation in a more palatable way. Palatable, right? But the outcomes are the same. And I think it's Corey Hofstein, my friend, who says, risk can, much like the first law of thermodynamics, risk cannot be destroyed, right? It cannot be created. It is only transformed, much like energy, right? And so it can move, but the pressures are there, the risks are there, and it really is a function of time and how that
comes back to where we started, right? Optimize your portfolio to the divergences from the mean of the expectation, right? Because that's what's going to drive the compounding path, and that's what this the population demographic thing could result in the one of the greatest deflations we've ever seen, or they can continue what they've been doing and result in ongoing greatest inflation we've ever seen.
Right.
But the average will mean nothing in that. Correct.
It's all about real.
Average is meaningless.
I agree. And the average is,
and it's the divergences that you need to be resilient to.
Mm-hmm.
And that resilience, going back to the rate, it will come from having good breaks.
Mm-hmm.
And by having good breaks, it frees you to explore the other side of that distribution.
Absolutely. Whether that's in currency or whether that's, interest rates and inflation, or whether it's nominal returns in markets. I couldn't agree more. David, every time it's better than the time before. I thank you for joining me today. Wonderful to finally do it in person.
So good.
Here in Munich, and I look forward to doing it many more times in the future.
I'll get to Chicago one of these days.
Oh, I can't wait.
Thanks.
Take care.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to your favorite podcast platform and follow the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged. But before we go, we just need to remind you that this podcast expresses the view of KaiNexus LLC and the guests appearing on the podcast as of the date of its recording, and such views are subject to change without notice. KaiNexus LLC and Top Traders Unplugged do not have any duty or obligation to update the information contained herein. Furthermore, KaiNexus LLC and Top Traders Unplugged make no representation to its accuracy, and it shall not be assumed that past investment performance is an indication of future results. Moreover, wherever there is a potential for profit, there is also the possibility of loss. This content is made available for educational purposes only and should not be used for any other purpose. The information contained in this podcast does not constitute and should not be construed as investment advice or an offering of advisory services or an offer to sell or a solicitation to buy any securities or related financial instruments in any jurisdiction. Certain information contained herein concerning economic trends, performance, and other data is based on or derived from information provided by independent third-party sources. KaiNexus LLC and Top Traders Unplugged may believe that the sources from which such information are obtained are reliable. However, each of KaiNexus LLC and Top Traders Unplugged cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. This podcast, including the information contained herein, may not be reproduced, copied, republished, or posted in whole or in part in any form without the prior written consent of KaiNexus LLC and Top Traders Unplugged.